Well, awesome. Welcome, everybody. We're going to have a couple of announcements from Utah Business Magazine with Lindsay. So Lindsay, take it.
Thanks, Chris. My name is Lindsay. I'm with Utah Business Magazine, and I just want to thank you all for being here today and taking time out of your busy days for this. In partnership with Now CFO, our webinar today will cover how companies can prepare for merger or acquisition. Before we start, I do just want to go over a couple housekeeping items. We will have this webinar available for you to watch again, so be sure to share it with all of your friends after the webinar today. We'll have it online on our website at utahbusiness.com. And if you have any questions, please feel free to use the chat function on your screen today, and we'll answer it today, or any questions that we don't have a chance to get to, we will send to our panelists to have them answer for you after today's webinar. So Caitlin, go over to you.
Awesome. Thank you so much, Lindsay. Welcome, everyone. We're excited to have you guys for our webinar on preparing for a merger and acquisition or anything in the transaction space. I'm excited to kind of moderate this and introduce you to our awesome presenters today. A couple things, we are going to be taking live questions throughout the webinar. Please submit those to me through the chat, and we will do a live Q&A at the end. And so any question you have throughout this presentation, please submit it there, and we'll go from that. Let's see. So I wanted to introduce you first to our presenters. So I'm going to read their bios, but we've got with us today Garit Lawson with Forbes M&A, Chris Badger with Now CFO, and Mark Erickson with Tanner. Both of them are great trusted transaction advisors and have multiple years of experience in the space. And so they are experts, and I'm super excited for you and me to learn from them today. So let's start with introducing you to Garit a little bit. Garit Lawson is a managing director at the Forbes M&A Group. He has 20 years plus of experience as a merger and acquisition professional. He is known for his expertise in advising company owners on successful strategies for maximizing shareholder value while accounting for the human needs and wants present in the business transactions. His transactional specialties are technology-enabled manufacturing, consumer products, and business services. Garit received his master's degree from the University of Utah in Business Administration and Organizational Development. Garit has founded and operated companies in the consumer and business services industries, giving him both distinct insights into business from the viewpoints of owner, manager, and entrepreneur. Next, we've got Chris Badger. Chris Badger is a partner here at Now CFO in Salt Lake. He is a hard-driving senior accounting professional who brings a broad and diverse industry expertise and experience to the firm. He has extensive expertise in financial reporting, due diligence, strategic management, along with all experiences in human resources, health insurance benefits, and retirement plans. Chris received his accounting degree from the University of Utah and has been a certified public accountant since 1997 and has also done over 25 years of professional accounting work. And we've got Mark as well here with us. A little bit about Mark. Mark leads the mergers and acquisition consulting practice at Tanner. He has 25 years of audit and business advisory experience, which includes 2 years on staff with the U.S. Securities and Exchange Commission. Mark specializes in serving a variety of clients in the technology, manufacturing, distribution, and banking sectors. Mark is a graduate from Utah State University and has a master's degree in accounting. He is a member of the American Institute of Certified Public Accountants and the Utah Association of Certified Public Accountants. Mark is also the chairman of the National Advisory Board for the Utah State University John M. Huntsman School of Business. So from their bios, you've got some great experts here presenting to you today. And with that, I'm going to turn it over to Garit to lead us out in our discussion. Once again, send your questions to the chat and we'll make sure they're answered.
Great. Thank you, Caitlin. Want to just begin with a brief introduction to the Forbes M&A Group, and won't spend a lot of time, but a little bit of background about the firm. The firm is a boutique investment bank, and we have offices in Denver and Salt Lake City, as well as in Nashville. And we were founded in 2004 and have grown to approximately 20 or 22 professionals at this point. our focus is really working with entrepreneurial and family-owned companies, and we help them primarily by engaging in transactions where they will be selling all or a part of their company in order either to exit the company completely or potentially to exit partially while bringing in a partner who can help them grow or bring other additional resources. We also work with companies to raise money, to raise capital, and typically that's with companies who are historically profitable. We don't do early stage or venture types of funding, but for companies that are looking to expand their facilities, potentially purchase a competitor, or just need to raise capital that potentially their primary bank cannot do, we'll help them go out and raise money. And so those two services are the primary focuses of our company. And generally our clients have annual sales of around $10 million on the low end, up to $200 or $250 million on the high end. And we work with companies across the country. Obviously, we have a focus in the Rocky Mountain region and in the Western US, but we also work with clients across the country and have access to buyers, not only nationally, but internationally when it makes sense. Great, I've got a question. Looks like it's a little more personal. I'll address that a little later. But Caitlin, I think that's probably enough of an introduction to myself and Forbes, and so I'll turn it back to you.
Awesome, thanks, Garit. We're going to move over to Chris. Turn it to him for a minute to tell us a little bit about now CFO, and then also his expertise in transactions.
Chris, it looks like.
Yeah, it's always fun when I leave everything on mute and start talking for 10 minutes, but just want to do a quick introduction with now CFO and our services. And so we're really, what I tell people is we're a hands dirty consulting firm. And so we actually will come out and do the work and get the work done. We roll up our sleeves and can hit the ground running in a variety of companies and industries. We do work here in Utah in manufacturing, high tech, healthcare, e-commerce, retail. We're members of the Utah Manufacturers Association. So there's a wide variety of companies we deal with. And we love to help out all companies, big or small. With now CFO, we're like many other entrepreneurial companies, and we want to be a nationwide firm. We're very aggressive on growth. And so I put this presentation together, and I'm already out of date because we just opened an office in South Carolina. And so I haven't met the partners there, but we want to be a nationwide firm and have that aggressive growth. As I went through and thought about the content or what we want to talk about today, which is really preparing for a merger or an acquisition, a buyout or a transaction. And I thought from the accounting department or from the accounting, what's going to add value in that transaction? What's going to add value to the owners? What's going to help them take more money out of the transaction or help the process be a smooth and easy transaction? And so I came up with the top 5 things that I like to see in a transaction. And the first thing I came up with is, golly, if the CFO is doing a great job there, they're going to have good monthly financials and interim reporting on a monthly basis. And so if the CFO is doing a great job, they're going to have timely and accurate financials. So a closeout on the 5th of the month and financial reporting and doing a P&L review. And that's kind of month in and month out. That's part of getting companies onto that financial discipline. And it's going to help smooth the process and make life easier for our CPA professionals like Mark do the Q&V or audits. And so having that monthly financial reporting tied down is really going to add value in that transaction. In addition to that financial reporting that I love, which, think balance sheet, income statements, statements of cash flow. I love financial reporting, but something that's also very valuable too in this process is having good operational reporting. And so think of this as your SKU reporting for sales, your monthly trend reporting, your product data. You want to be able to kind of go down to the next level of that financial data and be able to show, hey, what's selling better, this product or that product? What's our year over year growth? And having all that information on the operations of the company. And so along with that financial reporting package that I love, operational accounting and data that's ready to go. Also, another big thing that the accounting department or the accountants can add to this process or add to the valuation is having a good accounting system. And when I say a good accounting system, that's not QuickBooks. It's a mid-level software system. So think Intact, think Dynamics, think NetSuite. Okay. Take it up to the next level and have a good ERP system. When a company has a good system in place and it's being used and you're doing your reporting and your data from it, it's going to add value in a transaction. And what I tell people right now, don't be penny wise. And next year, you're going to be looking very foolish on the transaction, because good systems, good processes, good ERPs add value in the transaction. I always tell people, just rule of thumb, if you've got a good mid-level accounting system and software ERP system, that's going to add 10% in your transaction value. Don't skimp on your systems. The fourth thing I like is, having the right people on the bus. Think of that as kind of the appropriate level of person to go through a transaction. And again, we work with lots of companies, anywhere, think from $1 million of revenue up to 100 million. And it never ceases to amaze me when you get a $30 to $40 million a year revenue company, and you've got the receptionist and the mother-in-law doing the books on the weekends. Having a good transaction CFO to help you go through the negotiations and the due diligence is going to add a lot of value in your transaction. It's going to help you take more money out. And so make sure you've got the right people on the bus and you've got the right level of person that's going to add value to your transaction. And then my favorite, the last of the top 5 is, everybody's going to be asking the accounting department lots of questions. That due diligence process can go anywhere from a month to, I've had one go 12 months. Start putting the data together. Start putting the data room and getting your financials, the records of the company, get them put together so that when you get those questions in, you can very quickly and accurately get those out, because you want that information to be kind of at your fingertips. And so you may as well start putting it together now, because everybody's going to be asking for it as you go through the transactions. And so these top 5, again, from the accounting department's point of view, are going to add value as you go through this transaction process. And so those are my top 5 from the accounting point of view. I'm going to turn it over to my CPA buddy at Tanner, who's a true professional. He even did a little bit of tax, I found out, which was a little bit interesting.
Thanks so much, Chris. It's great to be with you all this afternoon. As was mentioned, my name is Mark Erickson. I'm with the firm Tanner here in Salt Lake City. And our firm, we're a firm of about 165 people. We provide traditional core audit and tax services to a very wide client base. And then we also provide a variety of consulting services in the financial consulting and tax, as well as some IT security space. I personally dedicate most of my time to the M&A consulting world. So I head up our M&A consulting practice here at the firm and spend most of my time working on assisting companies get through these transactions and make them happen. So there's a few things that I wanted to highlight today, and Chris, if you go ahead and move to the next slide there. So Chris was mentioning having the right people on the bus, and I think it goes hand in hand with assembling the right team. So obviously, who you have internally at your company is critical. Having the right people based on your size and complexity, having the appropriate expertise in-house is critical, but also having that expertise from outside parties is very beneficial as well. So some of the key players, if you're considering a transaction, you're thinking about selling your company, a few of the players that you want to look at, obviously having an investment banking team to help you prepare is critical. And Garit's going to spend some time talking about this and how critical that is. And one of the big advantages is the pool of contacts that they have that they can introduce you to. So they help you make sure that you're prepared, that you have the information ready, but then also make the appropriate introductions to help you get in front of the right people to sell your company. Accounting and tax experts, that would include both Chris's team at Now CFO that are in helping clean up the books, getting your accounting records and systems in order, posting any necessary adjustments to get your financial statements in accordance with GAAP, as well as outside parties like Tanner, who can provide tax expertise, but additionally some of the specialized accounting expertise. For example, you may decide that you want to prepare audited financial statements, and you can hire an outside public accounting firm to perform an audit of your financial statements. We're going to spend a few minutes talking about a quality of earnings report and what that means and what that is. That's another thing that an outside objective and independent accounting firm can provide and help you with, is providing one of those quality of earnings reports that will be very beneficial and in many cases required as you go to market. Attorneys and valuation experts, also very important, and members of the team to make sure that you're covered from a legal perspective and that you're not missing anything there. Valuation experts, actually, some investment banking groups have valuation expertise within their groups, and they can help you determine what is your company really worth and really put you on the right path for that. All right, Chris, we'll go to the next one there. So I mentioned a quality of earnings report, and many of you are likely familiar with what that is, but it is a very specialized report. It's a due diligence report, really a deep dive into the company's accounting information. And the nice thing about a quality of earnings report is it can be tailored and specialized to the specific needs of the company. So there may be certain areas that are very critical in your business, and other areas maybe that aren't, or that wouldn't be as critical to a buyer. And so a quality of earnings report allows us as a due diligence team to really focus in and drill down on those critical areas and provide valuable information, charts, graphs, detailed financial data that a buyer really needs when they're going in to perform a transaction or to buy a company or invest in a company. Some of the reasons why we do a quality of earnings report, in addition to what I just mentioned, so it's helpful to identify certain adjustments. Now, there may be, obviously, if you've had a group like Now CFO come in and clean up the books, hopefully there aren't a lot of adjustments that we find through due diligence to get your financial statements in accordance with GAAP, but there may be. And so one of the processes there is to identify any necessary adjustments to bring your in-house financial records in accordance with GAAP. But then also we present EBITDA and other derivatives of EBITDA in the quality of earnings report. And this really allows you as a business owner to provide really a more accurate portrayal of your company's performance. There may be certain expenses that are maybe one-time or unusual in nature, or maybe related party type transactions that if you were to sell the company, they wouldn't be included in the company going forward. The quality of earnings report allows you to make adjustments for those types of transactions and present really a more true accurate picture of what your business is going to look like going forward. Another reason to do this is really to show your preparedness and just be ahead of the game. When Garit comes in and takes you to market, when he presents your company to different interested parties, he is going to want to have a quality of earnings report in hand that he can then utilize in that process. I mentioned working capital. That's another very critical component in these transactions. Working capital is a pretty simple calculation. It's your current assets minus your current liabilities, but it always comes into play with these business transactions, with these M&A transactions, and knowing really what a buyer is going to be looking for, having an accurate picture of your trend in working capital is really important as well. Okay, so what are some of the procedures that go into one of these quality of earnings reports? Well, we want, one of the critical areas is revenues, and we want to drill down on those revenues. We want to make sure that the revenues that are being reported to the potential buyer are accurate. In the quality of earnings report, we'll do a variety of tests or gathering of information that we can present. A proof of cash analysis is very typical. This is where we basically perform a reconciliation between your bank accounts and your financial statements to make sure that they reconcile and that they agree with one another. It's evidence that those revenues that you're reporting on your books are legitimate, and you're actually getting paid for those revenues. Obviously, there are normally timing differences, but a proof of cash is a nice exercise to show that, that the revenues that you're reporting are accurate. I mentioned the EBITDA analysis and making sure that that presents an accurate portrayal of your business going forward. And so that's one of the deal challenges. We want to work with your team at the company as well as your investment banking team to make sure that EBITDA analysis really is reflecting all the right pieces of information that are necessary, both on the plus side and the minus side. For example, there may be a very critical position that you need to hire for in your company that you have not yet found that person, but you need to really to take your business to where it needs to go. That may be something that needs to be accounted for in the adjusted EBITDA analysis to show that, hey, we have an expense that we've got to add to our income statement because we need to fill this very critical position. So it can be both on the positive side and on the negative side, so to speak, when it comes to those EBITDA adjustments. So the speed and turnaround time is really critical in these things. They tend to move really fast, and you need a team that can jump on and crank things out quite quickly. As far as how long does it take, that's a question that we get quite often is how long is this process going to take? It varies. As Chris was mentioning before, the process can drag on for a long time, but the quality of earnings report, usually what I tell people is plan on about a month, plan on about 4 weeks. We've done them quicker than that, certainly, but generally from the time we start until the time we're able to issue a final quality of earnings report, I'd say average is about a month. And then lastly on this slide, I'll just quickly mention tax. Look, sometimes tax is a non-issue. It may be a pass-through entity, and there are very, very low risks when it comes to tax, but there are other times when this is a really, really big deal. And the only thing I'll say about it is identifying any potential issues early in the game and either resolving them or at least disclosing them is going to be significantly better than having a buyer come in, perform their own due diligence and find those issues. Being out in front of those is going to be significantly advantageous. So last slide here is just kind of the process that a quality of earnings goes through. Pre-assessment and planning, we have an in-depth discussion with you and the critical people within the company. We identify key risk areas from your perspective. We consult with the investment banking team as far as high risk areas that they consider to be critical and make sure that we identify those issues. We generate a needs list where we provide that to you and say, here's all the information we need, and it can be pretty comprehensive. Chris was talking about the data room, and the data room is a super critical part, being able to have that information that you can populate and provide that information. Once we have all that information, then we go into what we call our fieldwork fieldwork phase. And again, that's usually a week or 2 or 3, depending on the size and the complexity of the engagement. Once we've gathered all that information and performed our testing, we draft the report. The appropriate parties review the report, and then once we're all comfortable with it, then we issue a final report. So that's kind of the process. I just want to reemphasize, and then I'll kick it back. Chris mentioned being able to quickly respond to inquiries in a transaction, in a due diligence process. That is so important. Being able to have that information well prepared and available when those requests come through is so important, because it first of all, it speeds up the process. The process isn't being delayed because we're waiting on information. But then secondly, it makes you look competent. It makes you, it shows that you're prepared, that you know what you're doing, that you've taken the time to prepare for this transaction. So I wanted to reemphasize that, how important that is, of being well prepared and being able to provide that information timely. So I'll hop back on during the Q&A phase, but for now I'll kick it back.
And Mark, I'll jump in. One of the questions that has come through is, how much value does having an audit add to the purchase price? And I can let you respond to that. But I think since you've been talking about the Q of E, I think that in today's world, having a quality of earnings report done prior to going to market can add as much or more value than an audit. Audits measure different things, and valuations typically for companies are based on some measure of their profitability, and being able to go out to the market with an independent study that's verifying the true net cash flows of the company can not only get more interested parties, but can add value to the process. It also typically means that there's a higher likelihood that the transaction will be successful. We know that sometimes when a transaction fails, 75 or 80% of the time it's because the buyer's due diligence does not show that the true profitability of the company is what they thought it was. And so oftentimes that will come back and it'll lead to a price reduction, or it will kill the transaction. And so doing a quality of earnings, I think, is more critical for a transaction than having an audit done, which are often done at the request of lenders and other investors.
Yeah, and that's a great point, Garit. I'll just add one small piece to that. One of the, and some are maybe thinking, what's the difference? An audit is, the good thing about an audit is they're consistent. And so readers of audited financial statements know what they're getting, they know what they're looking, they're consistent from company to company because they follow an agreed upon set of standards. But when a firm like Tanner goes in to perform an audit, we have to follow auditing standards. And so auditing standards dictate what we do, how we test, the disclosures that are in the final report, how those financial statements look in the final report. It is a set of standards that we follow. In a quality of earnings report, there's significantly more leeway to focus in on those higher risk areas, present information in a slightly different way, present additional supplemental information that may be very useful to a buyer. And so it just gives us a lot more leeway on presenting information in a way that's going to be beneficial to tell the company's story.
Awesome, Mark. Thank you for answering that. And I'm actually going to pop it back to Garit a little bit to chat more about Forbes M&A and your process in this. And there was a question I'm wondering if you can answer it as we go through, but how do you match companies with potential investors, especially if a company is in a specific industry that has a limited or a small pool of investors?
Yeah, that's a great question. And I think the process of identifying potential buyers should be one that's very dependent on the company itself and the goals of the owners and shareholders. and there are a number of different categories from which potential buyers fall, and obviously one of those is within your own industry, or potentially industries that are adjacent to yours, that aren't the same but are similar, and potentially companies within those industries may look at acquiring yours as an entrance into that industry, where they can potentially bring additional products to customers, or additional customers. But there are also a pool of buyers out there that we typically call financial buyers, and these are made up of private equity firms or high net worth family offices, and these groups are really in the business of buying and investing in businesses, and they buy in them typically to grow them, to provide a return to their investors that exceed the typical public markets. And so they look for companies that are unique, that have very strong niches, that they're either the market leader in their industry, or potentially among a very few. And those are highly sought after by these type of investors, because they can bring additional capital, they can bring additional resources. They often have operating partners who have experience in growing companies. And so they can be good options for companies who maybe are very unique, or who have a niche, and there aren't a lot of others in their industry that might be natural buyers. And so I think in each instance, when someone looks at how to create a potential pool of investors, you have to look specifically at what they want to do. Do they want to sell and retire? Do they want to maybe keep 25% of their company and have a liquidation event, but continue to run their company and bring in a partner? And so each of those factors determines how you go about creating and reaching out to a pool of buyers.
Awesome. Thank you for that, Garrett. I've had a couple other questions though, and it looked like Chris, you were going to say something. I think you're on mute still. There you go.
Sorry. Hey, I just, for all the people here in Utah, so Garrett and Mark, this is a question out to you both. I'd kind of be interested in your input. You know, in this COVID year, right, we started out kind of very active M&A. It seems like things kind of got put on hold, or a halt there at the end of March and April. But I just kind of wanted to get your guys' input for what's happened, or what's happening here in the fourth quarter, and kind of what your outlook is on the whole kind of transaction space here in Utah, here at the end of the one of the strangest years that I remember, and if COVID's had any real impact on your firms.
Yeah, great question. So definitely, I think the M&A world did see a pretty significant slowdown, especially towards the end of Q2 and the first part of Q3, and throughout a good chunk of third quarter. I will say here in fourth quarter, I think I have been looking at more potential transactions than I ever have. And so right now, definitely the speed is very, very fast and very, very heavy. There are just lots and lots and lots of transactions that are in the works right now, or potentially moving forward. How much of that will bleed into 2021? I think a lot of it will. And based on what I'm seeing right now, most of these are targeting kind of that early, January, February timeframe, 2021. So a lot of these are already spilling over into Q1. I really think that, of course, there's tons of unknowns still, but I think 2021 has the potential of being a tremendous year for a lot of reasons. You still have a lot of cash out there that's waiting to be utilized, and you have a lot of business owners that have gone through some pretty significant trauma, and maybe thinking, maybe the time has come, and it's time for me to sell. You have others that frankly, COVID has been the best thing that could have happened to their business, and they have boomed because of COVID. There's quite a few of those out there as well. And so they may be looking at an opportunity thinking, hey, we're at a high point, and so maybe now is a good opportunity for us to sell. So my personal opinion is I think 2021 is going to be pretty busy.
Awesome. Garrett, how busy have you been here this fourth quarter? Because I
think I could echo much of what Mark said, that while there was a pause in certainly the second and third quarters as companies began to figure out how to operate and how to continue to grow potentially without having strong growth on their own, certainly the M&A market has rebounded. And what I can say is that valuations are still at all-time highs. It really is still very much a seller's market. And part of that is because if you're a company that has managed or even found a way to thrive during the pandemic, you've got, as Mark mentioned, a lot of cash on your balance sheet that you're looking to do something with. And so between that and the success of the financial buyers over the last 10 or 15 years has meant that they have raised a lot of capital. And so there's a lot of money in the market right now looking for acquisitions. And so that makes competition high. Interest rates are still at historical lows. And that means that buyers can borrow money at low rates that make it very possible for them to pay higher valuations. And you continue to have an aging business owner demographic who, despite the pandemic, is still looking to exit. And so I think it has been frothy and valuations are high and still very much a seller's market. And I expect that to continue despite whatever lingering effects we have from the pandemic through next year.
Thanks, Garrett and Mark, for your response to that. It's definitely interesting times, but good to hear that transactions have not slowed down. I do have a question that I received from our audience today, and I'm going to direct that to Garrett because I think this would work well with where he's at. But my company is 25 years old and specialized. I'd like to learn about selling, but I don't know who to trust or where to go or kind of what my first step is. Can you tell me what to do or give me advice?
Sure. I think that's probably a common predicament that business owners find themselves in. And I think that potentially a good place to start would be with your CPA or maybe your corporate attorney or some trusted advisor that you have who may be familiar with a business broker, an investment banker, or someone who they know and they trust. And that would be one way if you're looking to go to the market to get a referral to someone who you can trust. If you don't have someone that you can rely on to make that kind of referral, I think that it's important to, however you might locate a potential advisor, that you interview a number of them and you understand their backgrounds, you ask to talk to their previous clients, and I think you'll begin to find advisors that you can see have been successful, and when they haven't, why that is. But ideally, if you can find someone that you trust, who knows someone that they trust, would be the best way to locate someone.
Awesome, thank you. And you would be one that could connect them as well if need be, right? We've got all of our panelists' contact information here. And so Garrett or Mark or Chris could definitely steer you in the right direction if you need a contact directly today.
Absolutely. And if for some reason you're a business owner who potentially his company is maybe not large enough to work with an investment banker, but potentially a very good business broker, know all of the folks in town and would be happy to have a conversation with you. And if for some reason we're not a good fit, I'm happy to make a recommendation, someone who might be a better fit for you.
Thank you. So I've got quite a few questions, so we're just going to jump into all of these from the audience. This is interesting. We've got some questions on pre-LOI and post-LOI. So I'm actually going to throw this out to each of you if you want to take a turn at it. But what should be done to increase Okay, what should be done before the LOI to increase the speed after the LOI? And can you discuss the process after the LOI is received and what going through the due diligence process looks like? So tell us a little bit about the LOI pre and post process. Let's start with Chris, or go for it, Mark.
Well, Chris is probably the right person to talk about pre-LOI. I was going to hand it off to Chris and say, really, from my perspective, one of the most important things is getting your accounting and books in order. So Chris, maybe you can talk a little bit about that.
Yeah, I was going to say to build up to the LOI, think of it as after you have a good NDA in place, it's really kind of front loading a lot of that due diligence with the financial information and the financials and projections, and sharing that all up front so that there's really no surprises in due diligence. So if you do a good process before the LOI, after the LOI is signed, it should be a smooth and easy process. And that's, getting your financials and other data to the potential buyer timely and accurately, and being able to step them through that process. That'll make the due diligence process a lot smoother. Think of it as when you have companies that don't have audits or don't have good CPAs like Tanner, that due diligence process can now get strung out longer and longer. And so the more work you can do up front before the LOI is, the smoother the process will be once you get it in play.
Yeah, and I think from my perspective, as we've been engaged to go in and do a quality of earnings report, the ones that have stalled and that have been troublesome to get completed, it's usually because of accounting issues that we encounter. So we go in and we find things aren't quite in order. There's some pretty significant accounting adjustments that are necessary. There's large accounting errors. They aren't accounting for revenue appropriately, some of those things, and that can stall the process and really hold it up. So getting that kind of done and handled before the LOI is signed is really advantageous to all companies. Mm-hmm. Now, once that LOI is signed, then things really start to move pretty quick. Your investment banking team or business broker, whoever it is, they're going to be pushing pretty hard to get things moving. And so we'll be engaged quite often pretty quickly after an LOI is signed to start the quality of earnings report. Now, we usually provide our needs list to companies. We like to give them a week or two to get everything ready, because it does take some time to pull together all the information that we need. So we kind of provide them with that list and say, here it is, focus on this over the next week or two, and let's really get things ready. And then we'll start in earnest. And as we're doing and performing the quality of earnings report, Garit and his team have a lot of things that they're working on and doing simultaneously. So you kind of have different parts of this process that are moving down the road at the same time. We're over here doing the quality of earnings report, but Garit and his team they're preparing all the materials that they're going to take. They're working on all those projections, the valuations. I'll let Garit talk about all the other stuff, but those processes are moving down the road simultaneously. So Garit, I'm sure you have a lot to add to that.
Yeah, I think, at the LOI, which is letter of intent, if you're not familiar what that means, which is essentially the offer that the buyer has made to you and you've agreed to that, opens up a period where the buyer then spends 60 to 90 days typically really verifying all of the information that they've been told about your business, including all of the accounting and information, which is very critical. But they're also going to be looking at your customer relationships and your distribution or supply chain relationships. They're going to be looking at any legal issues. They're going to be looking at your historical, organizational, and corporate documents. And so they'll be looking at your insurance coverages. It's a very thorough process where they're trying to understand everything they can about your company. And so to Mark and Chris's point, as much of that information that you can gather beforehand and anticipate it, because it's also a time where you're really being interviewed. And so the more quickly and responsive you can be to the buyer's requests, the better that they feel towards your company and your ability to perform. And so it really is very much, as well as a vetting process, an interview process, and it also, there's an adage in this business that time kills deals. And so the quicker that you can get through the due diligence process and get to a closing, the better. And the more that it drags out, the less confidence, the more likely that some external factor like a pandemic can creep in and hurt your chances of closing. So it is very important to be as responsive as possible during that time frame.
And let me just add one point. I probably was a little confusing there, because one of the things regarding these quality of earnings reports is quite often one is done on behalf of the seller, but then the buyer may also engage a firm to do one as well. And so you may engage an accounting firm like Tanner to do a quality of earnings report well before that LOI is signed. That's what Garit and his team are going to use to kind of go out and find a buyer. After the LOI is signed, that was the quality of earnings report that I was mentioning earlier. The buyer may very well bring in an accounting firm to do another quality of earnings report that's probably very similar to the one that we previously have done. And so it isn't uncommon for these transactions to have two quality of earnings reports done. One that the seller prepares ahead of time so that Garit and his team can take that to market, and then a second one that the buyer engages to do their own independent due diligence once they have signed that LOI. So I apologize for the confusion there. I didn't mean to muddy the waters, but I thought I should clarify that a little bit.
Thanks, Mark. That actually led in perfect to the next part of what I'm going to chat about, with that there's two sides of the coin, right? There's the seller and the buyer side. And so we did have someone in the chat say, well, what about the buyer side? What does it look like on the buyer side before an LOI, or what are some of the steps that a buyer should take when looking to purchase a company? I'm going to let Garit take that and kind of jump with that.
Yeah, it's a great question. I think that from the buy side, oftentimes what drives a buyer's interest in a company is the ability to create synergies between those two companies. That maybe more than just a cost savings by potentially eliminating some personnel. Really, from the buyer standpoint, I think you should be looking for targets that are strategic, and that the combination of the two companies is more than 1 + 1. But and that's a sharing of there's no duplication of customers, or you have products that will fit for the target's customers, or potentially they have geographic access that you don't, or they have other sector experience that you'd like to enter into, but you've been unable. And so we oftentimes see one of the value drivers for a business is a barrier to entry. And so as buyers are looking at companies to buy, they look at a trade-off. How likely is it that I could just start, go into this person's business myself and build it? And so for a buyer's perspective, if you've tried or you decide that it would take too long or take too many resources to really have success within this particular sector, then maybe it makes sense to go buy it. And while you may pay a few years of net profits for it, it accelerates your ability to get into the market. You can increase your sales and that company's sales through the synergies. And so I think those are all pretty critical if you're on the buy side looking for a potential company to buy.
Awesome. Thank you, Garit. In addition to that question, I'm going to tack on one more. But when you're selecting an M&A advisor, how important is the deep sector experience in the target deal?
Okay, I think that could be very. I think it'd be very dependent. Certainly, working with an investment bank that has deep sector experience can be important in terms of really understanding what are the particular value drivers for that industry. And so knowing what kind of characteristics your company has that buyers within that industry are really looking for that can be very helpful in telling your story. And they may have access to more buyers within the sector. I think there can be a downside in that oftentimes if you see a investment banker or an advisor that does work exclusively with a certain set of buyers in a sector, they may be less likely to push for every last dollar for you as a seller, because they've got to go back to those buyers time and time again. And so oftentimes you may get a trade-off because they're interacting with those buyers on a regular basis and may be less likely to want to push them and definitely in the advisor standpoint, if you're on the sell side, there's nothing wrong with having the buyer at the end not quite be so happy with you because you force them to pay top dollar for the company. And sometimes within a sector experience, my experience is that may not be the case.
Awesome, thank you. Another question I'm gonna toss over to Chris. What is the likelihood of cap gains tax change, tongue twister for me, in 2021, and what will that will that impact the M&A space?
That's a great question, Kayla. I think it's going to more depend on what's going to happen in the Georgia Senate runoffs. And so right now, if the Republicans maintain control in the Senate, then I don't see much changes on the national tax situation. And so the biggest changes in taxes happened in that first year that Trump took office when he controlled the House and the Senate. I don't see that happening in 21 right now. Obviously could change, but obviously keeping the capital tax as low as possible spurs a lot of investment, which I think right now is a good thing for the United States. You know, the business of America is business, and I think having good tax law with low rates to spur investments is a good thing. And so right now for 21, you know, I'm not a great projections guy, but I don't think there's going to be much change right now, because I don't think the Democrats are going to win the Senate. That means kind of a stalemate. I mean, look at it. They haven't been able to pass the second CARES Act, and they've been working on that since last May. And as long as the House is controlled by the Democrats and the Senate's controlled by the Republicans, I don't see much change for next year. And at least from what I've seen and what I've heard from people, I would echo what Mark and Garit have already said, a very active fourth quarter, and a lot of that spilling into 21. And there's a lot of dry powder out there for investments and purchases of companies.
Awesome.
You know,
Okay.
Chris, a good corollary to that, I think, is a question that's come up in the Q&A, was that should I include my financial advisor in the negotiation process? And we haven't talked much about shareholders or an owner's financial advisors or their wealth advisors, but as it relates to, you know, capital gains taxes for business owners, it's really, you know, what the net is you get to put in your pocket, not necessarily what the top sales price is. And so I think having your financial advisor part of the deal team from early on, that to understand what is going to be the taxation on this transaction. Is there a way to structure it to minimize those taxes? And then if I've had my business for 20 years and I've used it to live off of, now if I'm going to sell it, how am I going to live off, and how much money do I need to live off? And so I think including the financial advisor as part of the deal team from early on and keeping them involved throughout, they can help look at, if you've received a number of offers, they can look at that and see how each one might result in different ways of being taxed on it. So I think the financial advisor, understanding capital gains rates, those kinds of things, is a very important person for the deal team.
Love that. Thank you, Garit, for adding that. I think I agree with you 100%. I've got a question from Mark, and it's kind of a twofold question. But okay, so how do you protect yourself when you're talking to a potential buyer who is also a competitor, as they do the due diligence process and see which products are most successful? how do you prevent the sale from backfiring? Or what are some things you can do to help it so that you're not put in a rock and a hard spot if it doesn't go through? Or what are some of those red flags that you can see in that process? Loaded question, but take a shot at it.
No, that's a very tricky dynamic, and I totally get that. And there are trade secrets that and confidential information that a seller may be very, very hesitant to provide to a buyer. And that's totally understandable. And by the way, not necessarily uncommon. And so it's not going to kill the deal. It's not going to create an obstacle that can't be overcome generally. Matter of fact, I'm working on one right now that is this exact scenario. And so the way it's working in the current deal that I'm working on, basically we are kind of the middle party. And so the seller, because we've been able to sign documents with them that they know we're going to keep the information that they provide to us confidential. And so they are willing to provide detailed information, customer information, things like that to us as the independent due diligence service provider. By the way, we were hired by the buyer to do the due diligence in this case. And so, but the seller is comfortable with providing us that information, but the information that then we provide to the buyer is we don't provide specific names. There's a lot of kind of redacted type information that we'll provide to the buyer. The buyer will be able to perform their own analysis over the company and its performance and everything, but they won't have specific data regarding customers and specific products and things like that, at least at this stage of the deal. And so that is certainly one way you can go about doing that is, through legal agreements and so forth, get comfortable that you can provide that confidential information to that kind of middle party that is not going to be shared with the buyer. And there may come a time in that deal process where it's going to be necessary to share some of that information, but maybe you want to wait until the deal is a lot closer to closing before doing that. Attorneys can help with that as well, as far as kind of providing some teeth in those agreements from a confidentiality perspective. So that's again, this is one situation. I'm in the middle of that right now, and that's how we're handling it. Chris and Garit, anything to add to that?
Yeah, I was going to echo what you said there, Mark. I've seen some deals fall apart because they just don't want to share, and the risk is too high for them because they're head-to-head competitors. If it's really truly a competitor that's trying to buy you, it's one of those things where you really got to kind of lock down the LOI to really set the process in place. The one that I saw fall apart did not have the LOI was not a good process, and it fell apart very quickly in due diligence. I've seen others go through, if you've got a good LOI in place and they want to make a deal. It's one of those things where if it's truly a buyer that wants to make the purchase, there's going to be a deal to be made. And so, but as business owners, you're going to have to make your own risk decision, your risk adjustment for it. But yeah, you've always got to be careful, and it's something that you take in your trusted advisors, and do you really want to go down that path with the risk that could be out there?
Yeah, I think that's true. I think it starts with a very good non-disclosure agreement that includes language that does not allow potential buyers and your competitor to use the information they gain from the process to compete unfairly against you. And then you stage the information that you provide them. And as Mark says, you start out by giving them redacted sales by customer, so they don't know your customers' names, and you don't give them access to employees and key pieces until each step of the process they verify that they're truly interested, that they're qualified and capable of making this purchase. And so selling to a competitor, a direct competitor, may not always be your best bet. They may not be the guys that will pay you the highest amount because you bump up against to them every day. But when you are, I think you can do as these guys, which is you got to be careful. You've got to stage their access to information all along, making sure that they're doing the things that that demonstrate that they're serious and capable of closing the transaction.
Thank you. Awesome answers to the questions that we've had. We're at our hour mark, and so I think just to wrap up, let's go ahead and have each of you guys say your number one most important bit of advice that you'd give to either a buyer or seller or anyone kind of moving forward in this direction. And we'll go with Chris, then Mark, then Garit, and then we'll close it out.
Awesome. Thank you, Caitlin. Great question. So I'm an accountant at heart, and I love if I've got that monthly financial package and close out, and I know where I'm at month to date, year to date. I'm going to be able to answer questions very quickly and easily. And that's going to be the number one value add in this sales process that I'll be able to add, is having that monthly financial package that's tied out, that's closed out, reconciled, and correct.
Awesome. And I agree wholeheartedly with that, Chris. It makes the process go a lot better. We've said this already. I said this when I spoke earlier. Having the right team, I think, is just so critical to having a successful transaction. It can make all the difference. And having the right people that you can work with, that you're comfortable with, that you get along with, and that you have the confidence in that they'll be able to help you through this process, I think is very, very critical.
And I would say that it's never too early to start preparing for a transaction. Ideally, you should begin thinking about it as you're starting your business. But there are a lot of things that business owners can do over the course of maybe a couple of years to dramatically increase the value of their company, from putting in institutionalized systems to creating a committed management team to creating barriers to entry, that you should think about well in advance of deciding to sell your company, so that these are things that not only add value, but may mean you get more cash at closing. It may mean it lessens your transition time as the owner. And so people should think about it well in advance of a potential sale, and really include it as part of your strategic planning, because the kinds of things that buyers find valuable in the marketplace and will pay more for happen to be the things that make the company more profitable, even if you never sell it. And so it's not like you're doing extra work. It's understanding what drives value in the eyes of the buyer, and then spending the time in your strategic planning to create those characteristics in your company.
Awesome. Thank you. This has been a great webinar, very informative, very great content. Thank you for all of your time and effort being here with us today. Just a couple end of meeting housekeeping items. We will be sending out the slides along with a recording link for you to view, and then also to share with anyone that you know in this space or interested in moving forward in a transaction. If you have any questions whatsoever, feel free to reach out to Chris, Garit, or Mark. All of them are happy and capable to answer any questions. We'll make sure to send their contact information out as well for you. And with that, thank you everyone for attending. A big, once again, thank you to the Utah Business Magazine for hosting us. I don't know if there's anything that they want to finish off with as we end this webinar. But everyone, thank you once again, and have a great rest of your Wednesday.
Thank you all. Have a great afternoon.
Thanks for joining us, everyone. Join us for our next webinar.